Hello, everybody, and today I'm going to go over my valuation of IDEX or Ideanomics Incorporated. It's basically a Chinese firm, but they're registered in here in the United States, but their main factory now is in China. So normally when I'm doing for my own personal thing and valuing a company, I don't usually. If I would have seen the results I saw in the financial statements of this company, I honestly wouldn't even have gone. I would not have made this model. But just in case anyone wants evidence, or maybe someone will see something I don't see in this model, I continued with it. So I wasted a few, probably an hour, maybe two, on making this model and researching the company. However, if it helps anyone make a decision, then I'm all for it. So, because that's what I'm not really here to recommend a company. I'm here just to help people make decisions. So, let's go over this real quickly. It won't take long. So, here we go. The To go back over the company in general, they've switched their main business model, their core business model, like three or four times. Like, it started off as a video on demand company in China called You on Demand, You on Demand actually, and then they changed to petroleum, something about petroleum industry. They're trying to involve blockchain and artificial intelligence, which is so is everyone else in the world. So that didn't impress me much. And now they're trying to get rid of they are through with the petroleum industry, and they're wanting to focus on the electric vehicle industry, selling fleets and even to individuals. So yeah, already when I'm looking, my main thing is I'm looking for a competitive advantage. I've seen that they've been in two or three, Lord knows what industries I didn't even read about that they've tried to enter. And obviously they haven't even achieved a profit, so I can't say that they have any competitive advantage whatsoever in management, product, manufacturing, whatever. But anyways, for the sake of this video, basically I've got to skip over the majority of this model because only thing I can say really is their revenue growth for the past 5 years is high, 76.4%. And even that is not giving them the credit they deserve, because 2018 they had $377 million of profit versus 2015 they had 4.6 million. Industries have changed for them in that time, and the main sources of revenue have changed as well. But really, when you take the CAGR of just those 4 years, I think it was something like 300% growth, which is amazing. So it's possible. I'm not sure what happened. Like I said, I didn't take enough time to research what happened in 2019, but it decreased back to even pre-2017 revenue levels. So, but to include that 2019, the revenue CAGR is still 76.4% for the past 5 years. I used my pessimistic. It didn't matter what I picked as my optimistic or pessimistic. Either way, my highest value possible was worthless. You would actually, in my opinion, if you bought a share of this company, you would be losing value. You would basically be giving away your $2.27. If someone gives it to you for free, take it. Sure, you got nothing to lose. But right now, at $2.27 per share, I feel like this company is only destroying value for the shareholders, which goes against the whole idea of firms are there to benefit the shareholders. So I cannot give this company my blessings. I will say, however, the balance sheet was decent, surprisingly. Current ratio and quick ratio, oddly enough, for an electric vehicle company, they have no inventory on the balance sheet. So current ratio and quick ratio are the same thing. And a decent ratio, 1.20. Anything above 1 is a good sign to me, or a positive for me, pretty good. tangible book value per share, which is total equity per share minus the intangible assets and goodwill per share. So that comes out to be 7 cents. So you technically have some tangible book value. If you could get it for less than 7 cents, I would recommend it because they literally have that in physical assets per share. So debt to equity is actually not bad at 19%. Surprisingly, I just thought it would be higher than that, but I really don't like that for a new company. It looks like they're mainly financing through equity, which is more expensive, has a higher weighted average cost of capital than debt. But debt obviously isn't going to help them anyways because they're not even making a positive profit, so they're not paying any taxes. So it just keeps getting worse and worse the more I evaluate them. And then to top that off, if you look at the next metric, the intangible and goodwill make up 45% of their total assets. That's a lot of not physical stuff that they're considering their assets. So that's not a good sign. That's a red flag for me. That's a pretty high ratio right there. And then free cash flow, obviously, they haven't had positive free cash flow for a year since I researched them back in the fiscal year 2015. So that's obviously going to be negative. And for recent quarters, it actually does look good. In Q3, they had $10 million of revenue, which apparently I read in the statements that 10.1 million of that was coming from the electric vehicle segment, their main segment now. So that's actually, when I read that, I actually was, somewhat interested, but I still cannot comfortably tell anyone that I have any evidence whatsoever that this company is going to be any more profitable than the next electric vehicle company. Now, here's where things get a little also. Apparently, the accounting auditors, the public accounting firm that they chose, which is actually one I've never heard of, BF Borgers in Lakewood, Colorado. I've never actually seen a company use someone other than the Big Four, but I'm not saying that's a bad thing. I'm just saying I've actually never seen that before. And a lot of times I don't research smaller companies, so that could be it. But still, even smaller companies usually get, one of the Big Four to do it. However, I actually like this company because this not the firm, but I like the CPA firm. They said that they do believe the financial statements fairly represent the company's financial position. However, they did put a going concern uncertainty. Anyone familiar with accounting or financial statements knows that in accounting, one of the principles of accounting is you assume the company is going to continue in the foreseeable future, and if you don't see that, you do need to make a note about it in the somewhere in the notes of financial statements, the independent registered public accounting firm report. But basically they say they're basically saying in a nice way that it's not looking good for this company. The way they sum it up is it has incurred recurring losses from operations, has net current liabilities, and an accumulated deficit that raises substantial doubt about its ability to continue as a going concern. But when you look at the balance sheet, they've got a positive total equity. But like I said, they're raising this by selling more shares of equity. So, they're not raising it from the business model. They're literally just taking people's money that who knows how familiar these people are with their business plan. So, with loss from actual operations, these people are losing money year after year. The last little screenshot I got there, the company has significant transactions and relationships with other parties. There's a lot of that going on here too. There's just a lot of it even dilutes even more of the core of my emphasis of putting focus on the core of your company. And then, there's Borger CPA, and they've only been auditing them since 2018. So take it with a grain of salt. But yeah, no, that's my review of IDEX. Please like and subscribe and let me know what you think.